Last week, the IMF put out a statement saying that 1/3 of our global economy will enter a recession in 2023. This is because, according to the IMF, quote, the United States, the EU, and China are all slowing down simultaneously. And this comes at a time where the Federal Reserve Bank is expected to raise interest rates again in the United States on February 1st. And our economy here in the United States started off with layoffs, and of course, more layoffs. Now, while technically it hasn't been declared that we are in a recession here in the United States, for all intents and purposes, the majority of Americans here in the United States feel like they are in a recession because your wages aren't keeping up with the high inflation, and that makes it harder to pay for your rent or your mortgage, it makes it harder to buy your groceries, it makes it harder to pay for your airfare, and really just continue surviving. But not surprisingly, it looks like 2023 is going to be rougher than 2022. Let me read you the first sentence from the BBC article. The head of the IMF said that 2023 will be tougher than last year as the US, EU, and China see their economies slow. The reason why this is so important to understand is because according to the IMF, you're going to see people feeling the effects of a recession even if their country is not in a recession, because you have some of the biggest economies in the world, the US, the EU, and China, all seeing their economies slow down. And the interesting thing is that each one of these three economies are seeing their economy slow down for different reasons. First, on the topic of China, here's what the IMF head had to say. I was in China last week in a bubble city where there's zero COVID, but that's not going to last once people start traveling. China has kept an extremely tight stance on COVID in their country even until now, and what that has done is it's restricted their economy because they're not letting some people go to work. Even if there's no COVID, you still have restrictions even until today. And the worry, according to the IMF, is what happens when COVID cases rise again, when people start traveling again. And these restrictions and lockdowns have hurt the growth of the Chinese economy. Take a look. This article is from CNN, but what it says is for the first time in 40 years, China's growth in 2022 is likely to be at or below global growth. Before COVID, China would deliver 34, 35, or 40% of global growth. It's not doing that anymore. We live in a globalized economy. So when the Chinese economy is hurting, it hurts a lot of other countries. It hurts a lot of Asian countries, and it hurts us here in the United States. In the first week of January, we got some new bad news about the European economy, and some analysts are now predicting that the European recession is going to be worse than expected because of that. The triggering factor in the EU isn't COVID lockdowns like China, it's the energy crisis that they're facing. Countries across Europe have been so reliant on Russian energy for many years. And now that Russia has turned off the energy supply to Europe, Europe is now facing the consequences of high energy costs and not enough energy. This energy crisis across Europe has caused inflation to go through the roof in Europe, literally, and now this is causing even more financial pain to people in Europe because the cost of everything is rising so fast. And couple that with the fact that you have a lot of people that are carrying a lot of debt, and Europe, unlike the United States, doesn't have 30-year fixed rate mortgages. And so you have their central banks in Europe that are working to raise interest rates, and all these debt holders, people who have mortgages, people who have other types of debt, are seeing their debts readjust in 2023 and 2024 at much higher interest rates than what they had before. This means higher and higher expenses while incomes are not keeping up. This brings us to what's happening here in the United States economy. Now, of course, if you want to stay up to date on what's happening in our financial markets when it's happening, then the easiest thing for you to do is to join Market Briefs, which is my free financial newsletter, because every day my team is breaking down what's happening in the global economy and our own economy and the housing market and the stock market and the crypto market into a fun, witty, and easy to read email. You can read the email in less than 5 minutes every morning, and even if you don't have a financial background, not only are you going to understand what's happening in the financial markets, but you're going to look forward to reading Market Briefs every morning. So Market Briefs is a simple and easy resource for you. If you haven't joined Market Briefs yet, it's completely free, and I'll put the link to how you can join for free down in the description below. Here's what the IMF had to say about the US economy. The US is the most resilient, and it may avoid recession. We see the labor market remaining quite strong. So the IMF is the most optimistic about the US economy, especially when you compare it to the EU and the Chinese economy, which kind of puts into perspective how bad things must be in the EU and Chinese economy, because we're already facing a lot of economic slowdowns and concerns here in the United States. The issue here in the United States is, for one, we have super high inflation, and this high inflation is hurting the economy. Now the Federal Reserve Bank is working to raise interest rates to bring inflation down. However, raising interest rates hurts the economy even more. So the Federal Reserve Bank is playing this teeter-totter game where they want to bring inflation down, but they don't want to push us into a deep recession. Now the question is, where is the United States going to be in 6 months, 9 months, 12 months, and 24 months? While nobody can predict that, you can start to see that our economy has been slowing. We've been seeing contractions throughout our economy, especially in the tech sector. Now the banking sector is starting to hurt as well. We've seen a number of banks start doing layoffs and talk about doing even more layoffs in 2023. And this is going to continue to happen as long as we continue to raise interest rates. When you raise interest rates, it makes borrowing money more expensive. When you make borrowing money more expensive, it makes it harder to do business. And this is especially difficult when we've been in such a low interest rate environment for so long. After the 2008 crash, we've been in essentially a 0% interest rate environment since then. So for the last 14 years, we've been in an extremely low interest rate environment where our economy has become so used to extremely cheap interest rates. But now the Federal Reserve Bank is working to ramp up interest rates faster than really ever before. And that's going to have consequences. And you're doing this at a time where we have more outstanding debt than ever. There's going to be consequences to that. Now, I know I'll probably sound like a broken record by now, but this is where it's so important for you to do two things. One, be prepared. Two, be financially educated. Most people are not going to expect anything bad to happen because, well, they don't think anything bad is going to happen. And then the people that do think something bad is going to happen are just not patient. So the first thing is you got to be patient, and once you're patient, this is where now you can actually prepare and be financially educated. Prepare means, one, preparing your finances from anything bad. That means building a savings cushion, making sure your job is good, and putting some cash aside to invest. Second is building your financial education, knowing what it is that you want to invest, learning about investing in your financial education. That way you can actually take advantage of opportunities that come your way, because the reality is 10 years from now, we're going to look back at this time and we're going to see a whole new wave of millionaires who were able to seize the opportunity because they had the right financial education and they were prepared. What happens anytime you see a bigger economic slowdown is credit dries up. It's harder to access cash. Investors become scared. People don't want to put their money out there. So now if you have cash, you can come in and take advantage of opportunities, which brings me to number 3, the first one that has to do with actually thriving through an economic slowdown.